Welcome to the deep dive. Today, we're tearing open the source materials to give you the essential knowledge and fast.
We are stepping right into the pressure cooker of corporate finance.
And we aren't talking about simple mistakes here. We're talking about these high-stakes situations where, one intentional small adjustment can just metastasize.
To a multi-million-dollar deception.
Yeah. So our mission today is to really unmask the auditor's specific, very complex playbook for identifying and responding to financial statement fraud. We're going to be guided by the professional standard, SA 240.
That's right. And this dive goes way beyond just the basic definition of fraud. We are focused on the heavy lifting that the audit team has to do.
So what are the objectives?
They're really triple-faceted. First, you have to proactively identify and assess the risks that a material misstatement might happen because of fraud.
Okay.
Second, you have to get sufficient, really undeniable evidence by using the right responses to those risks.
And third,
you have to know exactly how to respond when fraud is found or, even just suspected.
And before we get into all the mechanisms, I think we have to establish a key foundation for you, the listener.
Absolutely.
The auditor is not a legal detective. I mean, we can't be. We don't make the legal call on whether a crime has actually been committed.
No.
Our goal is to get what's called reasonable assurance that the financial statements are free from material misstatement.
And that reasonable assurance is, it's fundamentally harder to get when you're dealing with fraud versus just an error.
Why is that?
Well, if someone makes a mistake, it usually leaves a pretty clear trail. You can find it, you can fix it. But fraud,
It's designed to be hidden.
it's designed to be hidden. It involves intentional concealment, sophisticated schemes, and very often collusion, things like forgery, or deliberately leaving out transactions, or just lying directly to the audit team.
And if management itself is involved, I imagine it's even harder.
Oh, it's exponentially more difficult to pierce that veil of concealment.
Okay, so let's unpack the core conditions that, allow this kind of deception to even take root. Fraud doesn't just happen by accident.
No, it requires three things to line up. It's what's known in this context as the fraud triangle.
The fraud triangle. Okay.
Exactly. So first, you need an incentive or pressure.
And we're not talking about just minor stress here.
Not at all. We are talking about existential corporate pressure.
Yeah.
Management is fighting to achieve maybe some unrealistic earnings targets because their job or their stock options
Or the whole company.
or even the survival of the company depends on hitting that aggressive Q4 target. The pressure can be immense and very personal.
That pressure then leads directly to the second element, which is perceived opportunity.
Right.
And I think most people just assume fraud happens because of weak controls. But you're saying it's often more than that.
It is. Even perfectly designed controls don't matter if you have someone who knows exactly how to get around them.
Or if they're in a position of trust that lets them just override the system completely.
Precisely. The opportunity is that knowledge that the internal control system can be beaten. And then you have the most fascinating part.
Rationalization.
Rationalization. This is the psychological bridge that people have to cross. Even otherwise honest, ethical people can commit fraud when there's enough pressure.
Or they just have an attitude that lets them do it.
Right, a sense of entitlement or a belief that, the act is just temporary or somehow justified.
They tell themselves they're borrowing, not stealing, or managing expectations, not lying.
Exactly.
So if that's the psychology, how does this actually show up on the financial statements? Auditors deal with two specific types of intentional misstatements.
Perfect.
Let's start with the first one, fraudulent financial reporting, or FFR.
FFR is basically lying to the outsiders.
The investors, the banks.
The analysts, yeah. It involves intentional misstatements or omissions designed purely to deceive the users of those financial statements. And it often starts small, with little earnings management efforts that just spiral.
And the mechanics of FFR, they're key here. We're looking at things like manipulation of accounting records.
Or falsification, yeah. Or the intentional omission of really significant information like hiding contingent liabilities.
Or just intentionally misapplying accounting principles to make the results look better.
And that's it. FFR fundamentally relies on a manager's ability to override the controls that are already there.
How do they do that?
Well, they might record fictitious, really complex journal entries late at night, especially right near the end of the period when, oversight is a bit more lax.
Or they change the subjective estimate.
Exactly. Changing things like depreciation lives or warranty provisions to manage the income statement.
Okay, so if FFR is lying on the page, what happens when the intent is just pure theft?
That takes us to the second type, Misappropriation of assets, MA. It's just theft of the company's resources.
Simpler, but maybe harder to spot.
Often harder to spot because the perpetrators are actively covering it up with false or misleading documents. This could be classic schemes like embezzling receipts.
Like what, diverting customer payments?
Yeah, diverting collections on accounts that were already written off into a personal bank account, for example.
Yeah.
Or stealing physical high-value assets.
Inventory, intellectual property.
Right. Or, even more subtly, causing the company to pay for goods or services it never actually received.
Fictitious vendors.
Payments to fictitious vendors, getting kickbacks, or even using company assets like machinery or cash as collateral for a personal loan.
The goal is always to bury the transaction in paperwork.
Always.
So we've got the fraud triangle and the two main deception methods. But let's pause here and ask, where does the ultimate responsibility for stopping this really sit?
The source material is unequivocal on this. The primary responsibility for fraud prevention and its initial detection rests squarely with management and those charged with governance.
So it's their job first.
It is their duty to create a culture of honesty and ethical behavior and to back that up with active oversight and strong internal controls. The auditor only comes in after that system is in place or has failed.
And this is where the auditor's specific high-stakes job really begins. Looking for those precise warning signs, the fraud risk factors.
The red flags.
Right, the red flags that signal that the management culture is breaking down or that controls have become an opportunity.
Exactly.
Let's focus on those FFR risk factors first. What are the specific incentives and pressures we should look for?
We look for signs that the company's financial stability is seriously threatened. Maybe they're facing intense competition, or they have recurring negative cash flows, but are still reporting positive earnings.
That's a classic sign.
It is. Or maybe they have a marginal ability to meet their debt covenant requirements. That kind of stress, it increases the temptation tenfold.
And what about the personal financial pressure on the executives?
That's crucial. We have to look at their compensation structures.
Right.
Does management have a big part of their pay stock options? Bonuses tied to achieving aggressive or, frankly, unrealistic financial targets?
Or maybe they've personally guaranteed some of the company's debts.
Exactly. When their personal fortune is tied directly to the numbers they report, the incentive to fudge those numbers becomes immense.
Okay, so that's the pressure. Now, what creates the opportunity for this kind of financial reporting fraud?
Well, opportunity often breeds in complexity and a lack of transparency.
So
We look closely at significant related party transactions that seem to be outside the ordinary course of business. We examine assets and liabilities that are based on highly subjective, complex estimates.
things that are hard to verify independently?
Very hard to corroborate. Another big red flag is the use of tax haven jurisdictions without any clear, logical business reason. If it looks convoluted, it's often designed to hide something.
And the management structure itself can be an opportunity, can't it?
Absolutely. If management is dominated by a single person or a very small group without the compensating controls of an active independent board, that is a massive structural risk.
And the relationship with the auditor.
Always. A strained relationship, frequent disputes over accounting, unreasonable time demands, that's a huge indicator that management is trying to control the audit process, not cooperate with it.
Let's shift to misappropriation of assets, or MA. The risk factors here seem less about high finance and more about just plain vulnerability.
They are.
What makes an asset susceptible to theft?
Well, they usually fall into three main categories.
Mm-hmm.
Cash, how easy it is to convert, and high demand.
So things like
Assets that are small, high value, or easily convertible are the main targets. Large amounts of cash on hand, things you can sell easily like computer chips or diamonds or high demand inventory.
if you can steal it and sell it quickly without a paper trail, it's at risk.
That's the formula.
And the control deficiencies that allow this to happen, they often seem so simple, but they're so important.
They are the absolute fundamentals. Inadequate segregation of duties where one person can initiate, approve, execute, and record a transaction. That's the classic failure.
But there are others.
Oh, yeah. Look for things like inadequate oversight of senior management expenses, or this one is surprisingly common, a lack of mandatory vacations for employees in key control functions.
Why is that a red flag?
If someone never takes a holiday, They never give up access to their scheme.
And the fraud is never exposed by the person filling in for them?
Exactly.
So given all the sophistication and the fact that people are actively trying to deceive the auditors, the response can't just be passive.
It has to be highly strategic.
And that strategy is built on the foundation of professional skepticism.
That is the core requirement. The auditor has to maintain skepticism throughout the entire audit, recognizing that a material misstatement due to fraud could exist.
Even if you have a good history with the management team.
Notwithstanding any past experience with management's honesty, we have to investigate inconsistencies. We have to look at documents that might seem inauthentic. We don't just accept statements at face value because they were honest last year.
And this professional duty, it extends to the whole audit team. The source material actually mandates a specific discussion.
It does. A required discussion among the engagement team about how and where the financial statements might be susceptible to fraud.
So you're basically brainstorming how the company could try to trick you.
You're simulating the attack, in a way, and that discussion informs our whole strategy. When we're responding to risks at the financial statement level, we have to assign personnel with the right skills for that risk.
Makes sense.
We also have to evaluate whether management's choice of accounting policies, especially for those subjective measurements, might indicate an effort to manage earnings.
And this is where the strategy gets really tactical, moving into a kind of operational countermeasure. The auditor has to incorporate an element of unpredictability.
This is critical.
So you can't be predictable.
No. If we always test inventory counts at the same warehouse on the same day every year, management knows exactly when things need to look right. Unpredictability means varying the nature, timing, and extent of our procedures. We might show up at a subsidiary we haven't audited in 5 years.
Or test accounts that are usually seen as immaterial.
Or show up for a cash count, completely unannounced. It foils the perpetrator's ability to plan around the audit.
And because management is in that unique position to override control, that risk is considered inherent in all companies, right?
All entities, regardless of size. Which means there are mandatory, specific procedures the auditor must perform to address that risk.
What are they?
First, we must test the appropriateness of journal entries and adjustments, focusing specifically on those recorded near the end of the reporting period.
Because that's when the pressure is highest and the oversight is lowest.
That's the witching hour.
Second, you have to review accounting estimates. I imagine there's a lot of potential for bias baked into those assumptions.
Absolutely. We review those estimates for evidence of management bias, looking for patterns where estimates consistently push earnings up or expenses down. Finally, we have to evaluate the business rationale, or the lack of one for significant or unusual transactions that seem to be outside the normal course of business.
Like a massive, complex sale on December 30th.
With a shaky business justification. That is an immediate flashing red light.
Let's bring all these risk and responses to life now by digging into the case studies from the materials. Case 1. The revenue fraud at Arihant Ltd.
It's a classic.
This company had complex revenue streams, hotels, resorts, bookings, and the audit team initially made a catastrophic assumption.
They did. They concluded there was no material risk of fraud based on clean audits from previous years. This was a fundamental error.
And it was compounded by the fact that they knew the internal controls were bad.
They knew the controls over revenue were not properly designed to mitigate fraud risk. This case just underscores the requirement. The auditor must presume a risk of fraud in revenue recognition unless that presumption can be formally rebutted.
Which is pretty rare in complex businesses.
Very rare.
And the consequence of that failure to presume fraud was just staggering.
It was. It allowed a massive deception to flourish. Management failed to account for 43 crore in corporate hotel bookings.
And the mechanism was brutal.
It was. The money was partially received in the company's bank accounts, but the rest was routed directly to the CFO's personal account.
So it was both misappropriation and fraudulent reporting at the same time.
Happening simultaneously, enabled by an auditor who ignored known control deficiencies.
A tough lesson. Okay, let's look at another one. Alpha Manufacturing. A company under competitive pressure needed funding, so they were inflating sales.
Right. They were invoicing before delivery or using sales agreements with terms like excessive rights of return that legally meant they couldn't recognize the revenue yet.
They were creating fake receivables, essentially.
That's it. And this is where the auditor has to think beyond the typical procedure.
So just confirming the outstanding amount isn't enough?
It's not enough because the customer will just confirm they owe the amount. The auditor has to adapt and confirm specific details of the agreements.
Like the date of sale, return rights.
The delivery terms. If the customer hasn't actually taken possession, that revenue is likely invalid.
And I really like the required supplemental action here, inquiring with non-financial personnel.
Yes,
Talk to the people on the loading dock, the shipping clerk.
or sales support.
Yeah.
They can tell you if there's been an unusual change in sales agreements or delivery terms details that the accounting management running the scheme would deliberately hide.
It's how you bypass the accounting silo.
Exactly. Another crucial factor is management's attitude. We see this vividly in the Track Store Ltd. example.
Right. The internal auditor reported significant control deficiencies, unreconciled receivables, unreviewed credit limits.
And management just took no timely action to fix them.
So the lesson here is that management's inaction is a risk factor in itself.
A huge one. Failing to remedy known, significant control deficiencies shows an attitude that tolerates, or maybe even encourages, dishonest acts. It just sets the stage for bigger problems.
Let's consider the nuclear option. What happens when the auditor identifies a major misstatement that is clearly indicative of fraud?
Okay.
Say, fictitious purchases of 1.50 crore recorded near year-end with no evidence, or management just refusing to hand over an internal fraud investigation report.
At that point, the integrity of all evidence is just shattered.
Yeah.
The auditor has to immediately reevaluate the reliability of all management representations they've received up to that point,
And then determine their professional and legal responsibilities.
which can be severe. If the detected fraud exceeds a certain threshold, in India, that's currently 1 crore, the auditor has a mandated duty to report that fraud directly to the central government.
And beyond reporting.
Well, if the circumstances are so exceptional that they call into question the auditor's ability to even continue the engagement, they have to consider withdrawing.
And if they withdraw, they can't just walk away quietly.
No. They must discuss the reasons for withdrawal with those charged with governance and determine if they have external reporting duties for that withdrawal. It forces the whole issue into the light.
So as we wrap up this deep dive, it really comes back to the tightrope walk the auditor has to perform.
It does. They're required to get written representations from management, acknowledging their responsibility for controls and disclosing all known fraud.
But at the same time,
At the very same time, they have to maintain intense professional skepticism and be inherently suspicious of those exact same representations.
we've seen that fraud isn't just a numbers problem. It's a confluence of intense personal and market pressure meeting a systemic opportunity.
And the auditor's greatest operational challenge remains the risk of sophisticated collusion and, crucially, that inherent risk of management override, which can always bypass even the most robust-seeming controls.
So this leaves us with a final provocative thought for you to consider.
If sophisticated frauds often involve management overriding controls or creating these complex, opaque transactions, and the auditor has to rely on evidence that can be subtly falsified, how much of the reasonable assurance provided by an audit actually hinges on the fundamental but often unseen ethical commitment of the entity's leaders?